Premium gap opening on the 50-minute time frame. You can see we bumped this high. You see that here, the 1 minute chart. Sell side's been taken here. We want to see, does it have an interest to erode further, or if it wants to bang around inside this range. I'm prepared for it to be a rather lackluster morning session. 9:30 SIBI here, we're not factoring that. While yes, we are aware that that's there, I'm teaching him to use the one that forms at 9:31. For the folks that are comfortable with using the 15-second time frame, you may know there's a gap here that's still inside the 9:30 minute. It's good to note it, but it's not what we're using today. Opening range is between 9:30 a.m. to 10 o'clock. So that 30-minute interval, the algorithms use that as a preliminary range to establish, number one, the first imbalance, initial highs and initial lows, and then you use that information to build a narrative on how the daily range will build. That, and now I'm going to add the quadrant levels as well. Sell side's been taken, so there is buy side resting up here. We have minor sell side now at the low that's formed. So far on the 1 minute chart, we have no inefficiency except for the 9:30 candle. Still useful, but for your model, you have to use the next one after that, 9:31. 9:31 starts your seeking of a fair value gap. I would have rather had a larger gap between its low and its high. So in other words, yesterday's 415 or 414 settlement price on a 1 minute chart versus the 9:30 first printed price today. We want something ideally more than 40 handles. I personally like something that's closer to 75. This is your fair value gap right there. Okay, you see these relative equal lows. That's your draw for sell side. Now just be mindful, because I'm going to scroll the chart over so you're not going to see this. So because it's Friday, because we had a premium gap opening, because we have left that gap to the downside and traded below it, it could be viewed as kind of like an exhaustion gap, meaning that we gapped up there at the open of the session today, and then it trades down, fills the gap, tries to rally, and then folds and goes lower. So we can now use the low of the gap as a means of treating it like a fair value gap. In other words, if it trades back up into it and it struggles to get into it, and if it starts to roll over and trade lower, then we can use subsequent fair value gap, a very small short-term swing high, to be rated for like a turtle suit, where it just goes and gets a short-term liquidity and then bang and drops lower. TGIF, because we've had an up week all this week, 20% to 30% of the weekly range is usually what I like to see. It doesn't need to do it. If it doesn't do it today, then usually on Monday, you'll have some kind of a retracement into that previous week's range to the amount of 20 to 30%. All right, so we're inside that fair value gap here. So the setup running back into this gap here, you're going to study how it behaves here from this fair value gap down to the liquidity that's been noted with these relative equal lows right there. This settlement price here, I'm going to just put a box on it because I want you to see the color difference in terms of like a range. So because now we can see we gapped open higher with this price on this candlestick here, and the low of that shaded pink area, that's the actual gap. So that gap, we opened here, which is a premium. It's sold off, came back up, and then left the gap. You see that? And then right here, we hit it at the low of that pink shaded area. But it's also consequent encroachment of that first fair value gap of the day. See what's there on this candlestick right there hitting it? We would want to see, does it have the ability to want to, or an interest to reprice down to the sell side from there, because the underlying dynamics are, it's Friday, it's been going up all week long, it's healthy for it to go down there. Even if it wants to go higher, it can go down there and pick up this stops where they can buy from someone that wants to sell to them at a cheap discount price. If they can see that there's relative equal lows down there, retail traders would see that as support. And we like to look for areas where we can scoop up sell stops or short buy stops. And if you start blending these things together, you can kind of like flesh out a narrative where not just one thing is leaning on the basis of why you're taking a trade or why you expect the price to move a specific way. There has to be at least 3 factors there. And one of the main things is time. There has to be a reason for it to move based on time. And if you trade outside of the trade setups that are not factoring heavily on the element of time, you can still get setups, but you're not going to get that institutional sponsorship that comes with the moves that usually are delivered by a time-based mechanism. Like the first 10 minutes before you get to the top of the hour, so 9:50 to 10 o'clock, that 10-minute interval, and from 10 o'clock to 10:10, that interval is 20 minutes in interval. So that's a macro. So usually the algorithms will start firing off and it's spooling price to run to an inefficiency above or below the marketplace, or it's running to liquidity above an old high or relative equal highs, or below an old low or relative equal lows. So if you have these expectations on what price may do around that specific time, even if you don't have a bias, you can go in and watch the first few minutes of the day but you'll discover that you're learning how to discover the narrative for the morning session. You're not trying to predict daily candlestick right now, but you're just trying to get a feel for what is the most likely probable outcome based on where we opened up at 9:30 relative to where we closed at 4:14 yesterday. Where is the liquidity? Why should it be interested to go higher, or why should it be interested to go lower? What liquidity is there? Is it relative equal highs there? Is there relative equal lows there? Is there a large inefficiency above the market price, or is there a large inefficiency below the market price? So these are all questions that I ask myself, very specific things. And the times when you're watching price where it is so heavily handed on one side of the marketplace, where it's hard to argue the position from a buyer's perspective or a short seller's perspective. If you can justify it on both sides of the spectrum, being a buyer or seller, that's not high probability. We're inside half the gap. If we're bearish, even though we went through the fair value gap, it's fine. But because we went back into that opening range gap, which is that shaded area, it's pink, we want to see it stay out of that upper portion. So this red level here to this high up here, we don't want to see any of that. It can touch the constant encroachment, that wick, or another wick can trade up there, but we don't want any bodies up there. So we want this is like a no-go zone if it's bearish. So how do you use this information? Well, if it starts to displace lower and leaves and gets below this fair value gap, as long as it stays outside of this area up here, it can wick into it. We just don't want to start seeing bodies laying down in this area, because then it makes it even more likely that the market's going to be indecisive. So by having these parameters, it says you're willing to let it trade up here and still hold the idea that it could potentially visit down here for the sell side, because it's TGIF Friday. Thank God it's Friday. That's what it means. And it means simply looking for a 20 to 30% retracement on the weekly range. So the highest high of the week to the lowest low of the week, you drop a fib on that. And what the 20% level is, that's what my objective is to see, do we have a reason to frame something technically to get to that level? And I'll show you what that is in a minute. But in this gap here, right now, this is the framework that would be expected based on the fact that we didn't trade to the upper half of that opening range gap. So because we haven't even touched the consequent encroachment, if we leave that, come back up, you can touch that first fair value gap again. Because we have this down close candle and the market was going back up into it, that is a potential bearish fair value gap. And we went above it here. But if we leave it, I don't want to see it do that. While we did have the wick outside of it, the fact that we kept the body inside of it, that's exactly what I'm talking about. This is the very things I was mentioning when we first started the stream, that I have very low expectations, but I have to, because they're all listening and you're learning too. My personal expectation is, and the only thing that I would want to frame on a trade setup this morning would be a run into this area down here. Even if it's bullish, even if it wants to go higher on the day and keep going higher for the next couple of weeks, that this is still something that's reasonable to trade down into. And it's actually beneficial for it to go down there if it's going to go up longer term, because it's going down there to pick up more orders that smart money could buy at a really deep discount relative to where we opened up today. Because we opened up here at this price. And as long as we stay in the lower half down here, that's fine. That this narrative is still potentially there. Or inside the fair value gap, the first fair value gap. Why aren't you going short? Because I want to see it displace below it, leave a body close away from it, and that imbalance, I want to see, does it go back up into it and touch it again, like trade up in the bottom of it? And then I would expect it to trade lower. Or if you want to be very, very conservative, you can wait for it to do like it's doing here. It needs to close away from the low of that fair value gap. So now we have a small little imbalance right there. I would like to see this candlestick not come back up to it yet. Not yet. I want to see it close, leave that open. And then if it starts to drop away from that, that means this could be a breakaway gap. I don't like that, but now we need to see it displace from there. If it does it, you turn your attention over to the 15-second chart. And then the very first fair value gap that forms over here, once it trades back up into it, that could be a catalyst for you to get into a move to ride it down into the sell side here. Here, we're inside the time element of it, and you're blending first time. So the market should start spooling. That means it's going to run higher or lower. So how do you determine the direction? Well, we opened up high at the 9:30 price here relative to yesterday's 4:14. Professionals, they want to see it do what? Settle into that gap. And then the real picture will happen. It'll give you more insights about what the market will likely do. So by having an expectation on what the retail perspective trader will think, if we know that these relative equal lows down here are too obvious, there's resting orders down here. What day it is, where do we have an inefficiency? Where's their relative equal highs, relative equal lows? And all you need is just that, and you have everything you need to find setups that are going to never run out of supply. There's your gap right here on the 15-second chart. All you're doing is you're waiting for opportunities to see price behave in a manner that is obvious. It gives you immediate feedback. If the trade idea is right, you'll see all the things that would lead up to that setup come to fruition quickly. It won't spend a whole lot of time messing around at levels. Like if you expect it to go lower, everything that you would expect to see price use to keep it from going higher, If those factors are not being seen in price action, chances are you have initial feedback that your trade idea is probably not on side. On side means you're right about the direction bias. Or if you're in a trade that you're bullish, that means everything is indicating that the market's still going higher. And there's nothing that should upset you or make you nervous. By having PV arrays and by having things around time, expecting price to behave a certain way, the more things you can stack in your favor, you have to have a basis of what it is you're framing the idea on. And if you don't have that, then you don't have a narrative understood. Narrative is not bias. Okay, bias is, are you bullish or are you bearish? You got to go one step beyond that. Like, you got to know, where is it likely to go and why would it be realistic to assume it's going to go there? So my framework around the idea of getting down to these lows, if that is something that was happening on a Monday, it would probably be less likely to occur because Monday's a new week and they may be doing something entirely different to frame a narrative. Whereas it's Friday today. We've been going up every single day. So it's reasonable to see some kind of a retracement. And all you do is simply look for reasons to take out old lows or trade or reprice to old lows or an old low. In this case, we have just obvious relative equal lows. So it allows me to be comfortable with one side of the marketplace, waiting for a setup that is logical, that it is in a time that the market's going to behave a certain way where it's easy to see it, where it's easy, one-sided. Think about where we have opened at 9:30 and where we're trading at right now. Other days, when the market has more time in the week before Friday's close, it'll offer a lot better, cleaner price action, and you won't have all of this back and forth. The reason why we didn't have that large of a gap was indicating that it was going to be this kind of morning. If you're looking to trade and use large leverage, you can't do those types of trades in mornings like this. If you have a large gap, very large gap opening, you have the first signature that tells you, okay, yes. If you know what you're doing and you know what you're expecting, then you can see a little bit larger risk. We went to the top of the opening range gap here, went to the upper quadrant, you see that? And this type of action here, that's actually productive. I like to see that. If we get down below that fair value gap again here, same scenario, then we would want to see it. Now we've had the market redeliver almost to the top, but left a small little portion. See that? Watch your gap here on the 15-second chart. If it can offer some kind of a smaller fair value gap in the range here before this low is taken, then if it starts to sell off, it should accelerate and very quickly run down into here. Now we went back to the first 1 minute fair value gap here. This is your 1 minute first presented fair value gap, and it's valid because it is at 9:35. It's not on 9:30 candle. 9:31 to 10 o'clock, whatever fair value gap that forms on the 1 minute chart, that's yours. Basically, all this is telling you is the market's bullish when it's above it and it's bearish when it's below it. But we have to allow that volatility that occurs in the first 30 minutes to traverse above and below it. Then we get to a macro time. If everything is in play and they've already made the upper portion of it jagged, did they not take out this high with this run here? If it's bearish, it would have already went down here if it would have been a larger gap open because it had all the indications what it was. Not a very, very large gap. How we behaved right at 9:30 and what we've been doing has led to it's going to be a lackluster morning session. Now, that doesn't mean that hasn't had setups go up and down. And I did it with my private students last night too, teaching them how to practice and do drills. And we ran up $34,000 in just a little bit of time yesterday. Here, you're being met with a little bit more challenging environment. So you have to be highly selective about what you're trying to take a trade on. What would be inherently wrong about taking a trade if the market went below here? Over here on the 1 minute chart, let's say that you waited for a price to go below that and you went short down there. Would it be high risk? Would it be low risk? Because we have the smooth area in price action over here. Contrast that with, so below the market price, things are smooth. We have smooth lows here. The market has traded higher, taking out this short-term high, and we went into the upper half of that opening range gap. So it had aggression going up in the upper half of that opening range gap. Was it able to stay there? No. Where did the body stop? At this line right here, right? What is this line? It's the upper quadrant of the gap between 9:30's opening price and yesterday's 4:14 final settlement price. When it went up here, the bodies are telling you, yes, we went up into the upper half, not laying a body to the upper half entirely. It's just going to the upper quadrant level. It wicks, but it left a small little portion open up there. Because it's done these types of things here, I still favor the market wilting and rolling over and going down to attack and reprice into those sell side. I like to watch and how price behaves around its midpoint of its wick. I'd like to see it wilt right through that and then rush down into that sell side. The only time that it is AI driven is when it's time distortion. This is not time distortion. This is highly, absolutely 100% manually intervened. So as soon as you recognize those, just sit still and you're going to find that it's better knowing when to sit outside of these types of days. You have to encourage yourself, remind yourself that you're in this to make money. The takeaway is this. We can see that the gap higher in the opening was higher than the price at 414 yesterday. That means the initial bias during the opening range is bearish. We know that 70% of the time, half of that opening range gap gets filled or traded to in that first 30 minutes between 9:30 and 10 o'clock in the morning Eastern time. On a Friday, we know that there's a likelihood that the market will want to retrace 20 to 30% of the weekly range. All right, so we have a weekly candlestick. You see that sign? If we take the low, draw it all the way up to the highest high, go into your fib settings. Here's 20% retracement from the highest high of the week, and here's 30% of the range. The 20,421 level, we opened here on a Friday. We had a gap higher opening. So right away, you already know that the initial bias is it's going to go down to half of the gap. So we have the higher gap opening here at 9:30. So right away, we know in our mind, our expectation is it could flurry a little bit higher, but ultimately it's going to draw to that level there. Because as soon as we get that first opening price at 9:30, that's a static price point. It's not moving. It's not dynamic. It's not fluctuating around. We can still make a higher high on the day, but that constant, which is the opening price at 9:30 relative to yesterday's 414, we have that measurement that tells us this is where 70% of the time that price is getting hit in the first 30 minutes. So 34 has your first fair value gap there on the 1 minute chart. We create that fair value gap, trade down, back up. You could be short there with the expectation that it's going to go to the mid gap. Add to it, it's Friday. So that means we also have the 20% level. If we're bearish, we're expecting 20% to 30% of the weekly range to be drawn down to when it's been a bullish week. When it's been a bearish week, we're expecting the price to retrace higher to 20 to 30% of the weekly range. So now because we have an opening gap here, we already naturally have a built-in 70% likelihood that it's going to trade down here. So what can you use this level for? A partial. There's going to be exercises I'll put you through where as soon as you get an opening price like this, you're going to sell short. You're going to use a 30 handle stop loss and see which one gets hit first. I would use that mechanism to build my initial day trading with this idea. But you have a 70% chance is here from the opening bell, but then you have 20% of a weekly range. So this could be your target for first partial. Aim for this, but what happens if it just goes there? Is it likely to stop there? No. How far can it go? Well, you got 30% right there on the weekly range. So TGIF is giving you what? Partial target. The market comes right back up to 30% of the weekly range. Isn't that interesting? It's actually happening inside of a fair value gap as well. And then the market rolls over one more time into an inefficiency there and breaks down. What you're doing is you're trying to frame conditions where you have everything in your favor and it's hard to find something that would be opposing it. Based on what the market's doing and what I think it's going to behave like, low resistance liquidity run conditions where it's just going to be a liquid fluid market where it just runs real easy to my targets. It's not going to hem and haw, spend a lot of time bouncing around before it does it. Or is it going to be high resistance liquidity runs where I may have entered expecting something to happen and then something changes because it's manual intervene. High resistance liquidity runs most times are manually intervened. That means they're in there tinkering with it. They're trying to screw with the open interest in the market at that given time of that session. The only time that it's not doing it like that is just ahead of something that's a big red folder event that usually comes in the marketplace like a landslide and just decimates people initially. What will happen is the market just marks time. It just bangs around sideways. It's not a time for you to trade. What are the signatures that make a high resistance liquidity run signature? A lackluster opening gap, less than 75 handles. So right away, if it's less than 75 handles of an opening range gap, that already invites the likelihood of a lethargic, slow morning. Doesn't mean it won't trade. It just means that's usually a hallmark that starts it right away. If it's under 40, you definitely have a lackluster morning coming. So if it's 75 handles or less, I'm still expecting it could happen. That's why I'm watching that first 30 minutes. Because the first 30 minutes is going to give me the information I need to say, okay, we're in low resistance or high resistance conditions. You want to recognize as soon as you can if we're in low resistance liquidity run. Because if we are, your trades are going to be easy. They're going to be fast. They're going to be immediate feedback. You're going to get right to your targets. And your day is going to be quick, low stress day. But if you start recognizing, because we have an anemic gap opening, if the market is trading in a manner where it's just not trying to go to a liquidity quickly, and it's spending a whole lot of time inside of inefficiency. So see how we had a lot of time inside that gap here? This is your gap. How many times did we hit this? When we hit consequent encroachment like this and came right back up into it here, it should have failed at that point and broke lower, but it didn't. See, it did all this type of move. That right there was telling me, slow your roll. Don't try to press the button. Expect it to be harder. Your business is not gambling. Your business is trading and managing risk. And the first rule in managing risk is recognizing when that risk is going to be elevated. Having an understanding of how to discern when the market's going to be a harder adversary today. Remember, we recognized early on that it's going to be a lackluster day. That means it's going to be high resistance. So that means your draw is down here. Everything is framed on the basis of it's going to eventually reach for this relative equal low. So knowing that, your model is built around what? That first presented fair value gap. When we first traded down through it, it came back up, it hit the consequent encroachment, and we wanted to see price at that time displace lower and then find something maybe on a 15-second chart in this drop down, in the first retracement into a fair value gap. The fair value gap that would have formed on this 15-second chart, the first one will be right in here. But look at the prices doing in here. So we hit it, consequent encroachment, one more time, step up onto it, hit the low over here. Now, that in itself, that is something you want to see in a low resistance liquidity run condition, where it respects the level here and it respects the level here. But because we went this many times into it, here, 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 it's spending too much time in your fair value gap. Inefficiencies or gaps, you want them to go in, stick their toe in the water, and then run away. What's actually occurring is this. You have the shorts up here at the opening bell. It drops. The first retracement, that's optimal trade entry, they're short there. Sells off. If they don't take partials, they're going to have to weather this retracement, and now we got relative equal lows here. What is that doing? It's creating sellers below here, because retail traders are going to see that as what? It's bullish. It should have dropped here, should have dropped here. It didn't. And now look, we're marking time inside your fair value gap. That's not something you want to see. It's doing too much at a level that should have already had a high degree of influence over price. This should have never been going on at all. But because it's high resistance liquidity, it's holding price inside of a range. What range is that? It's the high here and the low here. At this point right here, who's been making money? The shorts. So what are they going to run for? Their stops. Where's their stop going to be? Above these highs. When it ran up into that, the wick did the damage, but it left that upper portion open. That tells you this level down here is going to get hit. All they did was last little run on the stops up here, and they left that small little portion open. That isn't, it's telling you, it's the algorithm tipping its hand saying, I didn't completely close it in, so that's your okay. It's going to happen now. If it would have completely closed it in and traded outside of it, this would have been less likely to be traded to. Is there anything about what I just said that you don't understand?
No.
Fair value gaps, when you're bearish, you want to see the upper half of it stay open. A fair value gap that's bullish, you want to see the lower half of it stay open. In here, what are you seeing? If we're bearish and we're expecting price to trade down to here, and all things being equal, that we thought that from the opening price it's bearish, we have 70% opening range gap to be traded to, and then once we get to the gap closure, we treat that whole entire range of that opening range gap as a inefficiency, and you treat it the same way as a fair value gap. So if it's bearish, ideally you want to see any turning point when it digs back up into it, stop at the lower half. The white area is the upper half of that opening range gap. We stabbed up into it, so that was that last little ditch effort of doing what? Wiping out anyone that's short, taking in anyone that wants to go long, but they don't have to be a breakout artist here. So longs are trapped long here, shorts are stopped out, and the short buy stop protection, they're being engaged with this rally here. So this is your Judas. Price comes back down, eats right through your fair value gap. It's exactly what you want to see. It leaves the upper portion of opening range gap, trades down through it, and then comes back up and kisses the low of that first fair value gap. That's your short. Your stop loss has to be above your first fair value gap. And your stop, in this case, because it's high resistance liquid, your stop has to factor that fair value gap's range. If you're getting short here, because you have a tendency to see deeper retracements that you're or less comfortable being in, the range of this fair value gap from your entry, you have to add that to what would be here, that's your stop, 2 times this. But if you're going to trade, you have to afford yourself the luxury of saying, I'm going to use a stop that is at least 2 times this range. That's your entry. That's your fair value gap. Your stop loss has got to be up here because it can retrace and wick through and then still go back down. So you have to refer to that frame of reference, that measurement of price. It's going to take a real move to get up there to take you stopped out. And that way it gives you the ability to stay with the trade longer, and you won't feel so scared about being stopped out. Versus if you just go in here and it starts to break away using a stop loss at consequent approach. On a low resistance liquidity run day, that's what I'd go 1 tick above that. But we're not in that. So your short would be entered here. Your stop loss would be where it was just mentioned ago. And then it trades down through the 15-second gap. But what is it doing in here? Is it showing a willingness to want to run away? It's spending too much time in there. So it's going to be a lot of this. It'll finally move in your favor, come right back up into consequent encroachment of that 15-second gap, break lower, not take out the low yet, come back up in here, drive below this low. The difference is this. On low resistance liquidity run days, you're going to see that the market delivers to the tick. How do you know there's manual intervention? Because that precision is not there. That means somebody's in there with a spoon and stirring the shit up. That's why you're getting these wild little runs outside of the inefficiencies here. All these little spiky moves, that's someone saying, I want these stops. I'm taking it all the way back up here to unseat those individuals that are already short, that trailed their stop losses here. Because there may be an entity that wants to be short and they don't have the size on they have intended to have on yet. You can still study, you can tape read, or you wait for the obvious disruptions. It spent time in this inefficiency over here. We've already did the damage up here. This was your Judas swing of the day. Even though it doesn't make a higher high than the opening price, this was the Judas. This is the thing that led everybody astray if they want to be bullish. And it also neutralized anyone that was short because the stops here, and even on this little high here is completely gone. They've turned all those buy stops that would protect the short position. They turned them into buy market orders, buying at the market. And anyone that would have used a breakout above this high here, they are tripped long. But if this then ran up here, this was all done by design with a hand. That was not artificially driven. This was not algorithmic. This was 100% manipulation. And then it went back down. And look how muddy it is inside the inefficiency again, inside that pink box. And then you see it drop down. This is where the algorithm's firing on what it would normally do. Then it drops down. And then right in here, this is where manual intervention came in. Everybody wants to get out here. So anyone that's short now, where's their stop loss? What is this? Smooth highs. Lower high than that one. So that means it's a valid what? Relative equal high. So they intervene here. They pump it all the way up. They consolidate in here and then jam it right up above this inefficiency, clear the stops. And then that's why you see it repel aggressively. Then it takes out that low and then it goes to target. But anyone that went short in here or trailed their stop loss, they don't get to have that ticket ride down here. Their ticket gets punched here, but they're frustrated because it goes down here where they thought it was going to go. And then after this, market retraces back up into the inefficiency, traces the top of the inefficiency here, breaks lower, and everything returns back to what? Algorithmic delivery. Everything goes back to precision, price point delivery. Manipulation, manipulation. If price is spending a lot of time or revisiting it multiple times before moving in your favor, you already know now what you're in. So what would you do in that instance? In my opinion, you should immediately drop down to the lowest leverage. If you're going to keep the trade on, as soon as you recognize that that's what's going on, slice it down to just one contract. Because number one, you probably would be booking some kind of profit by doing that. You're reducing risk aggressively, which is absolutely good. That's you being a risk manager. That's you being aggressive about protecting what's yours. Are you going to take the initiative to start looking at price like this? Are you going to compare every individual day going forward? Recognize the characteristics of that day. Was it under the delivery of high resistance? That means it's having a hard time getting to targets, a lot more deeper retracements. And the way you determine this by my PD array, the inefficiencies, the gaps, if price is spending a lot of time in them, you are absolutely in high resistance liquidity run conditions. So these conditions create what? Turtle soups. Here's a high, Judas swing up the upper half. Ideally, we want to see this left open. On a low resistance liquidity run day, this would have never happened. It would have already done enough in here by trading here, failing to go to consequent encroachment, and then rolled out of it. But because it is spending too much time here and it worked too many times here, turtle soup. Here's a high, runs the buy stops, drops. Relative equal highs, runs the stops, sells off. High, runs the stops, sells off. High, runs the buy stops, sells off. You see what's happening there? That's a characteristic of a high resistance liquidity run market. If you're bearish, look for turtle soup sells. That means look for small little micro shifts in market structure that would be viewed bullishly, but in reality, it's just them taking the short-term buy stops and they're accumulating the positions that those stops will afford them by being short. And then eventually you'll get to these targets here and eventually it went even lower there. And this is where we're at now. Is this an easy day? Not for a new trader, it's not. You're not going to see 2 days of seek and destroy in the same week. That never will happen. It will never, ever happen. But you will have a potential seek and destroy day, and then you'll have a day that's high resistance liquidity. And you'll have it like this, where it's a lot of give and take back and forth. And anyone else that's wanting to learn how to do this can recognize it is when you see your fair value gaps form, are we spending a lot of time marking price in them? Because that's the clearest indication. That's all I need, and that's all I ever use to determine it. But the main takeaway is this. If you can't recognize these types of days early on, you're going to fall victim to them. You'll be right about where your analysis is going and where the price is going to go, but you won't be in the trade because you're going to get knocked out or scared out of it. Well, here it is again. Here's a high, runs up, takes out what? That high, and then it drops and it attacks the lows here.